All right, everybody. Today we are going to be talking about overbought and oversold. If you listen to me, you know that I use these terms a lot and I focus on these things a lot. So, first, what do overbought and oversold mean? Well, basically, it has to do with the stock's momentum or an equity or security's momentum. And momentum is simply just a measure of where the price is today versus the price X many days ago. Um, the kind of the egghead term of it is, or definition is oversold and overbought are widely used terms that refer to when a security is believed to be below or above its true value. So these things are generally short term. Now, for this presentations or this lessons, I'm just going to keep this real simple and show you some simple examples. So my definition of overbought and oversold are when a security is more than 2 standard deviations away from its average price. Now, there are various ways to determine what the average price is, but a simple way is really, and this is what I'm going to be using in here, is to just take the average price, say the average weighted price of the prior 20 days or the average closing price of the prior 20 days. So it can get, much more complicated than that. So in theory, 95% of a security's movement should be within two standard deviations of this average price. So when this happens, it's time to pay attention, because when something is overbought or oversold, only one of two things are going to happen. It's either going to revert to its mean or it's going to start a new trend. So technicians use oscillators to define these things. That they measure the rate of change in a security's price. On my charts, you'll see this relative strength indicator, which was developed by Wells Wilder. And you can look at the calculation here. It's really a pretty simple calculation, but it's very effective. Rate of change is another one that's simple that people use. It's really just the percentage change of where something is versus X days ago. People like to use this one because I think it makes them feel like they're sophisticated. Stochastics, which is just, you can see here, it has to do with moving averages and minusing them from each other and dividing them and so forth. But it's in pretty much all trading software. I like these Bollinger Bands. I mean, they're not really an oscillator, but they show the 2 standard deviations. So if something is outside of its Bollinger Band, it's more than 2 standard deviations away from its average price. In my system, or when I look at things, I give it a little more leeway on the bottoms, because the bottoms are more volatile than tops, and we'll talk about that in our trends and levels lesson. So sometimes I'll put a 2.1 or a 2.2 standard deviation band on the bottom. All right, so here's an example of a couple of different oscillators. I took this stock, I don't know what it is, a Pezazine or something like that, but it showed up as a volatile stock, so I figured it'd be good for our purposes. So you can see here, right, that's outside of its Bollinger Band. That shows oversold, that shows oversold, that shows oversold. And you can see the same thing over here. Now keep in mind, these things all measure the same thing, okay? So my advice to you is to just pick one or two and just kind of master them. And these are also just set at default settings. Like I said with the Bollinger Bands, you might want to take your individual securities that you're trading and kind of optimize these things, because these are just the generic, default settings. So some of my charts, I tweak this, because I think every stock has a different trading personality. So you got to tweak it. There's really no one thing that works for everything. All right, here is Intel, and you can see it's pretty much the same deal. Okay, these guys all measure the same thing. So again, just pick one or two and try to try to master it. It's pretty funny when I see people that have like 8 or 10 different oscillators on their charts, because it's definitely overkill. Here's another one, just Bristol Myers. This one is illustrated pretty well. These things are all in tandem. So people trade off of these things too. There are ways to trade off of them. Like for instance, someone might have a trigger where like, all right, once this isn't oversold anymore, I'm sorry, overbought anymore, and the band is back in here, I'm going to sell it. So like breaking this band here would be a sell trigger. Or someone could have the same thing. Once something is oversold outside of this range, when it gets back in, that's my buy trigger. So you would have bought it there. So I'm not advocating any of these one or the other. I'm just saying that there are ways that people use these to put into their trading systems. A crossover could be a buy trigger. That could be a sell trigger. So, you just got to play around with them and figure out what works best for you. All right, so why are we talking about this? All right, we're talking about this because when markets are overbought at important resistance levels or oversold at important support levels, there are trading opportunities. All right, because what's going to happen? They're either going to revert quickly or they're going to consolidate. When something gets to an important level, it really doesn't just bust right through it. So we have to remember that bottoms are more important, or sorry, more volatile than tops, and that's because bottoms are driven by fear and selling is driven by fear, whereas buying is triggered by hope, and fear is a stronger emotion, right? So that's kind of a thing. If people talk about efficient market theory, if markets were efficient, they would go up at the same speed that they go down. At least I always thought that. But this shows you that markets are controlled by emotions. Okay, sorry about that. All right, so one of the things you want to do is look for capitulation days or capitulation volume and reversal days. A reversal day is basically a day that starts at its high, trades all the way down, then comes back and closes at or above the high of the day, prior high of the day, which was the opening price. And obviously it's the same, or it's in reverse on the upside, a sell reversal. So one of the things I like to do is find equities that are oversold and trading at levels that have been supported in the past. And then I can apply my trading rules to them to see if I can get out of a trade. So I guess here's the bottom line and the reason for this lesson. It's overbought and oversold at important resistance or support levels coupled with a trend break equals trade opportunities. And we'll take a look at a couple of those. All right, sorry. All right, so this is the 280 level, okay? So it got here and it made a reversal. So that's where you start looking, all right, well, when you get into this time frame, you look back and you say, all right, well, if it gets up here again, we're probably going to see sellers come out again, or have it be resistance. So the S&P gets up here, okay, to the 280 level. Or these are actually the SPYs, and they're overbought, okay? You see that? See how they're above their Bollinger Band? Then sure enough, they sell off. Same thing here. They get up above the Bollinger Band, which means they're overbought, and so they sell off. So that's what I just said before. When you get to important support or resistance, in this case resistance, and you're overbought, things could revert. Now here, it recently broke through 280, and today it's trading up around 286. But you can see here, it spent time consolidating, okay? And then it was able to break through. Generally, when things get to levels and they're overbought or oversold, they don't work their way through like here. And now we can see on the bottoms, okay, oversold, then that level becomes important to watch the next time around. Ends up being support here and support here. And you can see what I mean about bottoms being more choppy and volatile than tops. See, the tops are kind of just a little peak, whereas down here you get all this really volatile action. All right, and here is just a stock, one of these legal cannabis stocks that I follow. You can see that it got up to this 13 level, which was resistance back here. I should have shown it on the chart. But anyway, I don't know if you hear, that's my dog barking. Probably barking at nothing, or another dog walking by on the street. But anyway, we got up to 13, overbought, sells off, overbought, sells off. So, then when we got down here, we broke through this level. And now this is a resistance. All right, so here is something that caught my attention back in June. And like I said, I like to look for things that are oversold and trading at levels of prior support or resistance if they're overbought. In this case, I was looking at the 52-week low list. I have no idea what this thing was. It's some Brazilian fund thing. But, obviously it's clearly oversold, right? You can see down there, that's the RSI that I was talking about. Oversold here. This looks like kind of reversal pattern. And it's trading at this 13 level, which was the bottom back here. All right. So, I mean, could have made the same argument and started looking at it here when it got to that level, but obviously it just broke through. And that's why I said you need a trigger to enter your trade. And what I'm going to show you here is how to use trend lines, because if you just said, all right, well, the last time it got to this level, whenever this was, it rebounded. So therefore, I'm going to, buy it at the same level. Well, guess what? If you do that, you got run over. So you need to wait for the trend to revert. But again, this got on my radar screen because it was oversold. So it's ended up being a profitable trade. All right. So it broke through that 13 level I told you about. So then I got the feeling that that would be resistance. All right. So anyway, so it consolidates a little bit in here and it's not oversold anymore. And I entered my trade here when the trend line broke. Okay. I put my buy stop out here, or sorry, my sell stop here, because that was the low, prior low at 1120. And then when it got overbought and got close to my target, I sold it. So basically I bought it when it wasn't oversold anymore and it broke the trend line. Then when it got overbought at resistance, I sold it. So it ended up being a nice little trade. So the point is this is an example of how you can use overbought and oversold to make trades. This is the same thing. It's just closer up. So you can see I bought it on that date there after this trend line was broken. That was my sell stop. This was my target. And it got close to my target and it got overbought. So I just decided to sell it. And if you want to use a round level for a target, you should always take a couple cents discretion because it might not ever get there. Right? You might be at 13 and it could get to 12.99 and then you'll miss it. So I figured this was a nice place to take a profit because it was overbought. I think now it's actually up here, but whatever. That's a different lesson. Okay, kind of the same thing here. This got picked up on my radar screen because it was oversold. All right, so it was at 3. You can see this 3 was an important level for a long time, and it was closing in on 2. So when things go from 3 to 2, there's always going to be bottom fishers, right? That's just psychologically something's down whatever percent, but it's the nice round levels. People like to buy stocks that are $2. So again, you got to use the same thing I spoke about in the prior example. Let's see how this. All right, so this was my trade trigger entry. All right, the break of this trend line here. Okay, you can see this trend line. So I got in at 2 after the trend broke and it wasn't oversold anymore. Okay, then the thing rallies. I had a 250 target, but like I said, I took a couple cents discretion and I sold it at 245. So, bought it at 2, sold it at 245. That's a nice little trade. And again, I know nothing about this stock other than they're some kind of marijuana biotech stock. And who knows, maybe it's garbage and maybe it's going to zero, like a lot of these things are. But it's just an example of how, again, oversold at a support level, trend line break. And that's a simple way to make profitable low risk trades. Okay, here's a closer up just to see it better. So you can see it broke its trend on that day. I bought it the next day at 2. All right, my stop out was down here, which was 190 because that's where the prior low was. So anyway, it took a couple of days to get going. But as it rallied up here, I ended up selling it towards the highs of the day. And yeah, just because it was close to my target. I mean, my target was 250, so didn't want to overthink it. All right, now here's something that shows you about why it's important to use triggers, okay? So I was looking at this trade and I thought it was going to be a winner because see this 375 level? I mean, sorry, the 550 level was support for a long time. Then that finally broke, okay? It got oversold and it closed in on this level, 375, which I thought was important because it was support back there. So, I mean, sorry, it was resistance back there and resistance becomes support. So I was going to be up in this area here. And if it broke its trend line and bounced, I would have bought it up here. And this would have been my sell stop. And this would have been my buy target, just under there. But lo and behold, the trade was never entered because, you guessed it, the trend line was never broken. So it's still on a downtrend. Oh, I forgot to point out too, one of the other things that I thought was appealing was what I thought was capitulation volume, but you can see it's gotten even higher. So I suppose it's some kind of capitulation volume somewhere, but I've taken this thing off my radar screen. But anyway, the point is, if I just stood here thinking, oh, that's going to be a nice place to buy it, I would have gotten run over. That's why you need a trigger, and in this case, I'm using the trendline break as the trigger. All right, so these are obviously well-known dynamics in the markets. Traders such as myself, look at these things. A lot of this is just being done by quantitative modeling, artificial intelligence things. So that's most of what runs the markets today, the equities markets. The equities markets now are like commodities markets in the sense that most of the trading is done by traders or, people that aren't buying and selling for the long term. And it's kind of interesting because if you think about it, the capital markets were invented so companies could raise money, and now they're just being used so companies can make money trading. So that's how currency markets are, that's how oil markets are, and now it's how equity markets are. Oops. So here's the summary. Overbought and oversold can be defined as the price of a security being more than 2 standard deviations away from its recent average price. You can use oscillators to identify and define these things. When these conditions occur, pay attention because there could be opportunities for profitable trades. And overbought at important resistance plus an uptrend line break is a sell and a short opportunity. Oversold at important support plus a downtrend line break is a buy and cover trade opportunities. All right, so that's it. Just want to talk about overbought and oversold. pretty simple, but also pretty effective. Thank you.